In this course, you'll learn why do periodic financial analysis, how to do horizontal analysis of the balance sheet, how to do horizontal analysis of the income statement, how to do vertical analysis of the balance sheet, and how to do vertical analysis of the income statement. How healthy is your business? Even if you're making a profit year after year, performing periodic financial analysis can help your company in several major ways. It can show you the overall health of your business, help you understand why your income is growing, declining, or remaining the same, assist you in making proper decisions for your business, be used when applying for bank loans and other financing. Let's pretend you're a bakery owner. Customers love your product and you're making more sales year after year, so you might assume everything is going well. However, without an analysis of your financial reports, you could be missing some very important warnings that can affect the future of your business. Although your sales are increasing, the rate at which you pay for your supplies or employee salaries could be increasing faster, so it helps to take a look at them before it's too late. Two financial statements that will help you understand the financial state of your business are your balance sheet and your income statement. You will learn two different methods to analyze these reports, either horizontally or vertically. Let's take a closer look at your bakery's numbers. The purpose of performing a horizontal analysis on your financial statements is to compare how different entries have changed from one period to the next, and to make any necessary changes based on what you discover. Your income statement shows that your sales minus expenses equals your net profit. As an owner, you've tracked that information for the past 2 years. Now it's time to do a horizontal analysis, which is the new minus the old divided by the old equals the percent of change. For example, take your $300,000 worth of sales in year 2 and subtract your $200,000 in sales from year 1 to get $100,000. Then divide that $100,000 by your $200,000 worth of year 1 sales to learn that your sales have increased 50% from one year to the next. You can perform the same function with each line item, like your cost of goods sold, gross profit, salaries, rent, and net profit, to learn their rate of growth or decline as well. Examining your income statement in this manner can help you understand what has happened over the time period. For example, your sales have increased from $200,000 to $300,000. Therefore, it makes sense that your costs of goods sold have increased as well. While your rent has stayed the same, look at what's happened to your salaries. They've increased by 114.3% because you added additional workers. If you decide that the new expense is not worth the negative way it has affected your profits, which have remained at $5,000, even though you've had more sales, you can take steps to correct your hiring decisions, or decide to eliminate a product, raise prices, or cut other costs. Now let's take a look at how to perform a horizontal analysis of your balance sheet. Balance sheets show the worth of the company by comparing assets to liabilities and owner's equity. Let's compare different items on the balance sheet from this year and last year. New minus old divided by old equals the percent of change. Let's start with assets. How has our cash on hand changed from year 1 to year 2? Using our formula, you take $60,000 in cash for year 2 and subtract your $40,000 in cash from year 1, which gives you a difference of $20,000. Divide the $20,000 difference by your year 1 cash amount of $40,000, and you find that you had a 50% increase in cash. Let's look at another asset, inventory. Your inventory has increased to $100,000 in year 2 from $60,000 in year 1, which means you have invested in equipment or have lots of raw materials or products on hand that aren't selling. Although your percentages may not always total 100%, the percentage change of assets should equal that of the liabilities and equity for the equation to balance. In our example, the percentage change is 66.7%. This rate may tell you that your inventory has increased substantially. Therefore, use it to decide if you should purchase more materials or wait until your percentage increase is more in line with general industry norms. Notice how your current and long-term liabilities have increased 100% from year to year, too. This means you may have spent a lot of money on inventory. Compare these rates to what's normal for your industry and adjust accordingly. Now that you've seen how a horizontal analysis of your income statement and balance sheet can help you compare one year to the next for your own business, let's look at how a vertical analysis can help you compare rates within your own company and against industry averages. The formula for creating your income statement's vertical analysis is to put whatever field you're analyzing in the numerator and your net revenue in the denominator. Your net profit is $5,000 divided by $200,000, which is a 2.5% of net sales, which seems like a low percentage. By taking a vertical up and down look at your numbers this way, you can see how much of your money is going into each component of your business. For instance, you may notice that your cost of goods sold is 75%, which means that you're spending 3/4 of your money on inventory. Once you realize that the ratio is high, you can then start investigating why you're spending so much for inventory. Now let's perform a vertical analysis on your balance sheet. The formula for creating your balance sheet's vertical analysis is to place whatever field you're analyzing in the numerator and your total assets in the denominator. For example, your bakery may have had $210,000 in total assets in year 2, with $100,000 in cash. When you divide $100,000 by $210,000, the result is 48%, which gives you an indication of how liquid you are. That is, how much cash you've had on hand, or how easily you can convert your assets to cash. By comparing your percentages from year to year for your company, you can track the growth or decline in your amount of cash on hand, your debt, accounts receivable, and more, as a percentage of your total assets. You can also use these percentages to compare how you're faring across your particular industry. For instance, you may learn after conducting your vertical analysis that your inventory as a percentage of your total assets is right in line with your specific industry standards. Research might also tell you that your current liability rate of 19.1% as a percentage of total assets is standard across bakeries, but if it rises much higher, you might consider selling off inventory to pay off debt or make other decisions based on your findings. Conducting analysis like this periodically is vital to the health of your business.